African stock markets have had a very stellar performance in 2025, and those trends, by and large, are continuing into the first half of January. Let's take a look at the numbers in aggregate. In 2025, the main indices in Europe, the United States and Japan, and Hong Kong actually, they ended the year between 16% and 30% higher. Now, even if you strip out the wider American market and just focus on the big tech stocks who are driving a lot of the gains, think of Amazon, Meta, Nvidia, Alphabet, AMD, and so on, members of the so-called Magnificent Seven, the Bloomberg index tracking those, that was up 23%. Now, compare that to indices in Johannesburg, Lagos, Nairobi, Cairo, Casablanca, even Dar-es-Salaam, Tanzania. Those ended 2025 between 29% and 52% higher. And these, remember, these are in dollar terms. Based on 2025's strong performance, though, are investors taking a second look at frontier African markets in 2026? Tim Staermose is the founder of the African Lions Fund. In the 5 years since it was set up, the firm has mainly focused on investing in listed companies in niche spaces like Tanzania and Kenya. When we spoke, I asked him if larger markets on the continent like Nigeria are now attractive, especially after years of painful economic reforms.
Certainly, Nigeria was a market that was sort of uninvestable for me when I started the fund, given that they had a quasi-capital control situation in place with the Naira artificially pegged at a low rate, and then the unavailability of dollars for expatriating or repatriating funds from investors. So I don't have a large weighting to Nigeria. I have invested there. We do have 2 positions, and it is our 3rd largest weighting. It's a market that, as you say, has done spectacularly well over the last 12 to 18 months, partly as a result of having been so bombed out, but also they've taken a lot of hard decisions. They've instituted some serious reforms, and I think that's going to continue. So while we don't have as big a weighting to Nigeria as the market indices would in our space, it's certainly a market that we are constructive on, and we're looking to add exposure.
You spoke about inefficiencies in investing in frontier markets a little earlier when we started the conversation, and for a lot of foreign investors, these would be things like the commissions, for example, that would be required to pay if you're coming into specific markets, the ability to open a depository account, for example, and moving cash in and out of these particular countries. You've essentially been able to turn these into your edge in some respects. Walk us through your thought process there.
Yes, I think being here on the ground full time is quite an advantage. A lot of the funds that operate in the same space as me, they run out of London or Cape Town or New York or Chicago, places like that. And although those managers are all extremely talented and watch the space closely and travel out to Africa many times each year, it's not quite the same as being on the ground continuously as my team and I are. And that gives us some sort of an edge, not only in sort of getting news flow faster. I mean, it's so inefficient here that sometimes even just reading the newspaper can give you a bit of an edge. I've had instances where that's allowed me to buy stocks ahead of people sort of waking up later in the day in other parts of the world. But you're quite right. Inefficiencies in terms of the way the piping, the plumbing of the markets works is another thing. And you get to understand that a lot better if you spend time on the ground here and deal with the brokers and the custodians and everyone else face to face and get to learn the system that way. I mean, I get a lot of potential investors that balk at just the frictional costs that we have to deal with in these markets. But the way I look at it is they can only go one way, and that's down. And the same happened in every other part of the world back in the day when commissions were lowered and things became easier and more brokers started servicing the market. So I'm hopeful that we also get that here in the Africa frontier markets over the coming 5-10 years.
With respect to 2026, what are your broad macroeconomic concerns, if any, that you have that might affect the stakes that you have in some of these companies? Because just going by the banks that you hold in your portfolio, there's a lot of direct exposure to sovereign risk, given the amount of debt that these banks will be holding, government debt rather, that these banks will be holding on their books. And by the same token, indirect exposure to consumer sentiment and private sector credit demand. What are your big concerns for the next 12 months?
So I think it's important to note that each Africa frontier market sort of operates on its own cycle. We are in a current period in the markets where there's positive sentiment returning among foreign investors to this part of the world. But if you look at our two largest exposures, Kenya and Tanzania, they're at quite different points in the credit cycle. I think Tanzania is a lot further along, and we are very wary of the credit cycle here, having been in a boom period over the last 5, 6 years and very long in the tooth. Kenya, I think, is much earlier. Interest rates are coming down from very high levels. I do have concerns still about Kenya's sovereign risk and the fact that real interest rates are so high that many businesses just put off investment plans until rates are cut or the liquidity situation changes. That said, I think Kenya does or has made some difficult choices over the last couple of years. I know that the political administration is not very popular, to say the least, partly because of the impact that their policies have had on the average person's pay packet and people really feeling the pinch. But a bit like Nigeria, where they took a lot of pain, I think that pain has actually helped to stabilize the situation somewhat. At least it's better than it was 2 or 3 years ago when I was actually aggressively buying shares that I thought were quite cheap because I'd made the assessment that Kenya was in a tough spot, but it was not going to go the way of Ghana or Zambia or some of these other countries that did have sovereign defaults. But you're quite right. The banking sector in this part of the world is really a leverage play on the government bond markets to a large extent because of the way that they invest in government securities with a large part of the deposits that they take in, and that the capital base is relatively thin.